What do you make of what's been going on, Sailesh?
Well, I think in the equity markets, broadly speaking, emerging markets, and also including Asia in that camp, is that investors are somewhat thinking of a decoupling sort of paradigm once again, wherein, we're seeing fairly modest growth in the United States and growth decelerating in Europe, but essentially people thinking that, look, economic activity in this part of the world could potentially continue to remain resilient against these headwinds. So it's only a matter of time when the data points start turning south, over the next several months, that risky assets such as the stock markets and currencies do start falling. And my sense is that once we get past the November FOMC and we're starting to see weaknesses in the economic activity indicators in this part of the world in terms of significant downside surprises starting up, then we'll start seeing that sell-off, first mildly and then more major, I think, sell-offs in equities and currencies against the dollar, probably in the months of December or January, in my opinion.
Sailesh, but that's why you prefer bond markets over equity ones, yeah?
Well, for the near term, I would have to say so, wherein it depends on which bond market one speaks of. So, for example, I'm a buyer of essentially core European government bonds with duration, with the idea that we are getting economic activity likely to decline in the next several months in core Europe, and also essentially we should see further loosening of monetary policies in these markets. If you talk about the so-called PIGs, then the idea is you're selling on strength. And in terms of the U.S., we're not really going anywhere. And I think that in the near term, as expectations of significant further quantitative easing recede, we're likely to see 10-year bond yields in the U.S. Track up to 2.85 to 2.9%. But given that the economic data in the U.S. is likely to remain volatile for the next 3 to 6 months, we trade a narrow range in 10-year treasuries at 2.5% to 2.9% on the upper end of the range, in my opinion.
Sailesh, I want to just pick up about what you were saying there about Europe. You really seem to be of the belief that the worst is over there, then.
Well, that seems to be what the market's been focusing on over the last several months, where you've seen spreads across the PIGS markets compress significantly. The ratings downgrade of Spain yesterday, it was somewhat of a minor event. It was well within expectations. But I think the two key things that the market is ignoring in terms of PIGS, and note that there is heterogeneity within the PIGS markets, but the overall picture looks like the following, that we are seeing the sovereign ratings downgrades, and usually these sovereign rating downgrades are followed through by downgrades of the banking sector, and we have yet to see that. And lastly, we will see potentially continued upgrades of the fiscal data in these markets, and then impinging impact potentially on the banking sector numbers and potentially the economy over the next 3 to 6 months. So it's by no means over. And one thing I'd like to indicate is that euro-dollar is just behaving abnormally. And essentially, I think over the next 6 months, we're headed back down to 120 on euro-dollar.
Sailesh, we're out of time, but thank you so much for joining us. Sailesh there joining us. He's from Jefferies.